In fiscal year 2026, Privi Specialty Chemicals reported a massive 75% surge in their profit after tax. The broader market recognized that momentum immediately, pushing the stock price to trade near its 52-week high of 3,590 rupees. That rapid appreciation presents a clear analytical problem. We need to determine if this hypergrowth establishes a permanent structural baseline for the company, or if the best-case future scenarios are already entirely priced in at these levels. To answer that, we will run a strict forensic audit covering 4 distinct areas: the business's operational moat, the true quality of its earnings, its balance sheet solvency, and finally, a valuation synthesis. In the specialty chemical sector, trading at near-peak multiples requires stripping away the market noise. The goal is to verify if the underlying cash conversion engine can actually support that premium over the long term. We start by defining Privi's core operational advantage, which centers entirely on a highly efficient waste-to-wealth backward integration process. Look at this supply chain schematic. On the left, traditional chemical producers rely heavily on volatile crude oil pipelines and gum turpentine oil. On the right, Privi utilizes a proprietary CST loop. This system directly extracts high-value aroma chemicals from waste streams. Maintaining that specific process requires heavy intellectual property development, which Privi sustains through an in-house research and development team of 116 members. That operational setup benefits from 2 major top-line catalysts. The first is the China+1 supply chain shift, as global customers seek reliable sourcing. The second is the successful turnaround of Prigiv, their joint venture with industry giant Givaudan, which turned profitable in the 4th quarter. By utilizing waste streams instead of standard crude derivatives, Privi creates a structural buffer against global commodity volatility. That specific process engineering is the mandatory prerequisite for generating high-quality, reliable earnings. Phase 1 of our forensic audit tests the actual quality of those earnings. Privi reported an absolute profit after tax of 327.54 crore rupees for fiscal year 26. This comparative bar chart breaks down how that translates to actual liquidity. Next to the PAT bar of 327.54 crore, Privi generated 550 crore rupees in operating cash flow, establishing a robust multiple of 1.68 times their net income. A CFO to PAT ratio of 1.68 indicates high earnings quality. It effectively eliminates the usual red flags of aggressive revenue recognition or capital getting trapped in unpaid receivables. The cash generation is further supported by internal cost optimization and improved capacity utilization, driving EBITDA margins to 25.7%. When a company converts its net income into hard cash at that high of a multiple, it validates the 75% EPS growth as a tangible structural reality rather than a paper accounting trick. Phase 2 evaluates the company's balance sheet risk and working capital efficiency during this period of aggressive expansion. Even as sales volumes grew 22% year-over-year, Privi successfully compressed its working capital cycle down to exactly 117 days. Looking at their leverage profile, the company carries a net debt of 876 crore rupees, resulting in a highly manageable debt-to-equity ratio of 0.62 times. Their net debt to EBITDA ratio sits at a comfortable 1.33 times, providing a significant solvency cushion. This specific capital structure is currently generating a return on equity of 22.05% and a return on capital employed of 22.42%.
Compressing working capital days precisely when sales volumes are spiking is difficult to execute. Doing so while maintaining strong return metrics passes the ultimate stress test for operational discipline. Next, we analyze management's capacity expansion strategy, defined internally as the 5K to 1K vision. Over the next 3 to 4 years, the company is targeting 5,000 crore rupees in visible revenue, supported by 1,000 crore rupees in EBITDA. This step chart maps out the capital expenditure required to hit those targets. Privi is projecting 1,200 crore rupees in investments across 3 distinct phases, culminating in a total installed capacity of 74,000 metric tons. Phase 1 of that expansion is already nearing completion, pushing total capacity to 54,000 metric tons by June 2026. Because Privi generates 550 crore rupees in operating cash flow, they have the internal liquidity to aggressively fund this 1,200 crore rupee capex without stressing their pristine 0.62 debt-to-equity ratio. Phase 3 shifts to the capitalization table to gauge the conviction of the company's insiders and institutional backers. This dynamic donut chart breaks down the current shareholding structure, starting with a massive and unchanged promoter stake of 60.6%. Crucially, exactly 0% of those promoter shares are pledged, entirely removing margin call risk from the insider base. Institutional hands are also adding to their positions. Domestic institutional investors hold 10.7%, bringing the total institutional ownership to 12.04%. A heavily concentrated promoter base with 0 pledged shares and increasing institutional conviction acts as a structural downside buffer during broader market corrections. The final phase of our audit is the valuation synthesis. Taking the current market capitalization of roughly 13,600 crore rupees and dividing it by the 327 crore profit after tax yields a steep price-to-earnings multiple of approximately 41.5. This visual equation contextualizes that multiple against the company's recent growth. Dividing the 41.5 PE by their massive 75% EPS growth rate yields an attractive PEG ratio of 0.55. However, this stands in stark contrast to the price-to-book ratio, hovering at a restrictive 9.6 times. Management has provided forward guidance indicating that the 75% EPS explosion is a temporary spike. They expect growth to normalize to a long-term run rate of 20% top-line expansion and 20+% EBITDA margins. This presents a core valuation paradox. Investors buying at these levels are receiving a temporary discount on the immediate growth rate, but they are paying a definitive steep premium for the underlying assets. To summarize the fundamental side of the ledger, Privi Specialty Chemicals operates an elite cash conversion cycle, protected by a highly defensible waste-to-wealth moat. On the market side of the ledger, the stock is trading near its 52-week highs with a steep price-to-book multiple, meaning the fundamental margin of safety is incredibly narrow. Based on this audit, the verdict for existing investors is a firm hold. The underlying business is operationally sound enough to ride out the execution of their massive capacity expansion plans. For new entries, the recommendation is to accumulate strictly on broader market pullbacks. Avoid blind buying at the absolute top of the valuation range. Privi's operational execution is extremely tight, but in high multiple institutional investing, strict entry price discipline is your only defense against inevitable multiple compression.